Well, good afternoon, everyone. It's great to be here. We thank you for staying inside on a beautiful day. We think we got something that's going to be very entertaining for you. We're going to structure the session where it's very informational, but also gives you a chance to ask questions at the end. My name is Pat Talley. I'm a regional director for Lloyd's here in the U.S. I know what you're thinking. He works for Lloyd's. That's why he has that cool British accent. Obviously, I'm not from the UK. We have about 40 employees here in the US that work for the corporation, and that's our main role. But I think you're in for a fascinating session today. We're going to learn all about the Lloyd's Lab and the critical role that it plays in supporting innovation and technology within our industry. So let's just jump right in and talk about how we're going to structure the program. I'm going to spend maybe 5 or 10 minutes setting the stage a bit, talk a little bit about the history of Lloyd's and how we came to be in this place. After that, we'll give each of our gentlemen here from the alumni of the Lloyd's Lab 5 minutes to introduce their company, what makes it special, what it does, and maybe relate a little bit about their experience at the Lloyd's Lab. After that, we're going to ask a series of questions that we have deliberately structured from a regulatory perspective, so it helps you as regulators gain a deeper understanding of some of these emerging technologies and innovations, and maybe some food for thought about what conditions might need to be considered when structuring future regulatory oversight going on down the road. And then finally, at the end, we should have a few minutes, hopefully, for some questions of our panel from the audience. So let's just jump right in. So let's quickly talk about Lloyd's. I'm sure you've probably heard of Lloyd's of London, or we still refer to it both ways. The first thing to know about Lloyd's is that it is a marketplace. It is not a single company, which you've probably heard that before, but what does that mean? Well, unlike Travelers, Chubb, or other companies, it's actually a marketplace of about 50 different insurance entities who work together collaboratively to underwrite, share risk, and syndicate risk. So that's the key distinction to remember when you're talking about Lloyd's. The market wrote about $63 billion in premium last year globally. It did this through a complex and large network of trading rights that Lloyd's has developed over the years. Lloyd's has 80 direct licenses, so the U.S., Canada, Europe, Australia, but it has another 100 or so cross-border and reinsurance arrangements so it can source business from just about anywhere in the globe. And that's really important to keep in mind because that gives the market an enormous diversity of risk spread, both geographically and also from a risk concentration or correlation perspective. So while Lloyd's does have cat-exposed properties all around the globe, it writes so many classes of business in so many different places that you end up with a true risk spread and a very low correlation of those risks all occurring at certain times. And that gives you a much more even set of results. Lloyd's has an amazing history. It started over 3 centuries ago in a little coffee shop on the banks of the Thames River in London. Edward Lloyd had a coffee shop there, and it's where people would gather, merchants, the wealthy, just all types. The Starbucks of the 1680s, I guess. And that's where really the birthplace of this form of insurance came about. You had merchants who were trying to sell cargo all the way across the world at a time when it was very perilous to do so. You had no navigation, you couldn't tell about the weather, piracy, and all these other things. So the provision of capital met up with these people needing coverage right there in that coffee shop. So when we say we subscribe a risk, I'm an underwriter, I'm in the coffee shop, I say, look, I'll insure 50% of your ship. That's the limit of my appetite. So will you take 25% and you take 25%? So now we share it that way. We split the premiums, 50, 25, 25. No claims, everything's fine. Claims, we use the same pro rata method to pay claims. So that's essentially how the market operated then and exactly how it operates today. I mean, there have obviously been technology improvements and things to support it, but it works the same as it did 3 centuries ago. Very dry. So, also, I would like to point out that Lloyd's is extremely robust from a financial solvency position. It carries an A+ superior from AM Best, a AA from S&P, and I think the best way to sum that up, I love making this statement because it's so profoundly fascinating, is that Lloyd's has paid every single valid claim for over 330 years, which is just a remarkable achievement when I think about that it was, they were up and running for nearly a century before this country was even founded. So that never ceases to amaze me. Another thing we want to point out about Lloyd's is it has a centuries-old reputation of being an innovator, of being first to market in so many ways. Underwriters at Lloyd's continually scan the horizon to see what the next emerging risk is, because the first person who can identify the emerging risk is usually the person who can craft a commercial solution to deal with it. And Lloyd's has a long history, as this slide shows you. The first motor policy written in 1904, so I don't think there were a lot of cars back then, but Lloyd's said this is something we have to get into. They didn't even write an original new form for that. They actually used a marine policy, changed the wording so that a car was referred to as a ship navigating on land, which I just think that's really cool. First aviation policy in 1911. This was before commercial air flight was really getting off the ground, literally, pardon the pun. Satellite policy. They covered the launch of Intelsat in 1965, and to this day, Lloyd still covers those strange, large, asymmetric risks like space launches. Political risk. You saw a lot of upheaval in the early 70s, so Lloyd's developed the first political risk policies. And then, you know, we hear cyber every day. It's ubiquitous. But Lloyd's wrote the first cyber policy before the turn of this century in 1999 and is now still a leader in that market. So it's really important to look at that Lloyd's is always thinking, I want to be first to this. And so that's really sort of opens the door of why we're going to be talking about the lab here. So in 2018, Lloyd's made a big commitment and investment to set up the Lloyd's lab in 1 Lime Street. It's right there at the headquarters in London. And it was to give a dedicated workspace to foster innovation and really, I guess, overall, ensure that Lloyd's remains the global leader in innovative risk solutions. The lab offers several programs, but the flagship program is called the Accelerator. How does that work? Well, the Accelerator program is searching out insurtechs and companies that want to take advantage of Lloyd's special expertise in the specialty market. And so we run two cohorts every year for a 10-week incubator period. So, in fact, cohort 13 kicks off this month. So that shows you how they're 2 a year, and they're producing a huge alumni, which we're going to address here just in a second. So the application period is for about 6 weeks. It's open, and we usually get about 250 applications. So it's extraordinarily competitive. And then the market itself, the underwriters and brokers decide we're going to cull this down to about 12. And we let the market makes those decisions, because then they're truly invested in, have skin in the game to mentor and bring these new ideas to fruition, all the way up to and including potentially giving them capacity to begin selling their new product. And we see that happening all the time. So the market intensely mentors these individuals to bring them along. I think of it as sort of like Shark Tank on steroids. But so now when you say, what have been the results of all this? Well, we've had 12 cohorts successfully go through, so we now have over 600 Lloyd's market mentors representing 78 of our managing agents and broking firms, which is a large proportion. And it's resulted in over £1 billion of capacity that the market has bought to deploy to support these new burgeoning companies, which is, put your money where your mouth is. That's an excellent example of why that works. But what's really fascinating is the statistics at the bottom. We have 136 lab alums. 4 of them are here today. 97% success rate. So if you've ever looked at like angel investing or GoFundMe or any of these, speculative investment situations, it's more like a third or something. But 97% of these have either succeeded or have been sold. Someone wrote them a big check and they said, okay, we'll do our next thing. 85% of those who are involved in this are still working in the Lloyd's market, and 78% of them are still working with the people that originally brought them, mentored them through the program. So that's just a little setting the table. Now we want to talk to some actual, alum from the program. So we're going to go in and give each of you 5 minutes to do your elevator pitch. So let's do that. So first, let's welcome from Sixfold, Alex Schmelkin.
Well, thank you so much. I'm so excited to be here today. My name is Alex Schmelkin. I'm going to get the slides working. There we go. I'm CEO and founder of Sixfold. We are a generative AI company focused exclusively on insurance underwriting. We were part of Lloyd's cohort 12, which is the most recent one that graduated. And our business, Sixfold, we focus on helping underwriters be more effective and efficient in their day-to-day tasks. We wake up and we think that one of the biggest problems, at least in our industry, is $7 trillion of premium written globally, the vast majority of which is processed by really talented underwriters sitting at their computer or meeting with brokers, looking through submissions and looking through applications and day in, day out figuring out, is this a good application? Is this a bad application, and why? And it's a very important thing needed in our industry, but our approach has been to train a number of AI models to help these underwriters make their decision faster, be more accurate, and essentially get to a confident decision more quickly. The way we do it is we figured out a way to actually bring in each underwriter's unique risk appetite. A 150-page PDF manual, which the underwriters are trained on, which teaches them you're looking for these kinds of business, or you're looking for these characteristics of someone applying for life insurance. And our AI becomes very aware of all of these attributes of risk. So when it comes time for a new submission to come in the front door and the underwriter has to figure out, well, how do I price it, and is it good, and what questions do I need to ask of the customer? We essentially do all that background research and we present a case to the underwriter. Now, these underwriters, just to put things in perspective, most of them, good, busy underwriters, are reading more than 35,000 pages of documentation a year. That's like another novel every 3 days. And these are not romance novels. This is heavy, dense medical information and losses and risk information, and they need a break. They need a way to do it better. We provide primarily two things to the industry. On the left, we help underwriters really manage their day. So they're flooded with all of these applications. Let's pick the best ones. And then on the right here, you see our summarization capabilities. So all of this online research, risk capabilities that are actually looking deep into the submissions to figure out, how can I help you? People measure us. What's interesting, it's very cool, brand new technology, but we're measured in very traditional ways. So underwriters generally can't get to everything they have to do in any given day, and that's not the best experience for a broker or an end customer. And what we help them to do is process their cases more quickly, focus on the right ones, and ultimately be more accurate and cut down the time. I want to show you a demo. This may not play. If we could cue hitting play in the back, otherwise I'll wildly gesticulate and explain what's going on here. It's working. So one of the first things we do is I describe the ability to bring in the risk appetite. And what you're seeing here, although it's a little small, are all the different things that define risk. So this is a cyber policy, and it says if they have multi-factor authentication, it's good. And if they've had previous cyber breaches, it's bad. And now once that appetite is ingested into the system, we'll click on a risk here, and all the model needs to get started is the name of the company. So Batesville, they're located where they are, and all these different things are firing. So we found that they maybe follow some best practices. We figured out that they're a newspaper manufacturer, which is needed to be able to write them. We answer all these questions, like what are their backup practices? And in each case, it's going by pretty fast, but we show you where did we find this information, giving the underwriter more confidence that they're getting to the right place. Now, we also do this in life insurance. So our newer customers are the big mutuals. And now you could do the same thing. You pump in medical records and your MIB scores and your Part A's and your Part B's. And what the model is doing is it's surfacing to the underwriter and helping write descriptions of these are the most important things that you should be focused on. Ultimately, underwriters are in control. Underwriters are the ones that are making the final decision. We're just trying to help accelerate their path to getting to the right outcome. And just very, very briefly, working with Lloyd's as a relatively new startup, we're only 20 months old, was an absolutely amazing kind of market opener for us. We had only previously been doing work in the US, and now we're about to open our London office. We've expanded into UK, EU, and actually increased our US presence as well. So at least we're currently one of those 97% success stories, and we'll see where it goes as we continue to grow. I'll pass it on to the next one.
Thanks, Alex. Now we're going to bring up Armilla. Please welcome Karthik Ramakrishnan.
Good afternoon. Karthik Ramakrishnan, CEO and founder of Armilla AI. Well, as Alex mentioned, unless you've been living under a rock, AI is a thing. Everyone wants a piece of it. Everyone wants it in their companies. The challenge with AI is that it doesn't work perfectly 100% of the time. It's very different from the software that we're familiar with, which is very deterministic. You say it should do A, it will do A. The thing with AI is it's a probabilistic model. So it makes some decisions on its own. It has a guesstimate on what the answer should be. Now, that gives the power for AI to do what it needs to do, right? All the capabilities that we're talking about. But that little inherent uncertainty presents now a risk built into every piece of software that now goes in. Now, if you're familiar with some of the stories in AI, that translates to things like hallucinations, wrong outputs, biased outputs, et cetera, et cetera. So that's how these risks really manifest themselves. So as enterprises go into adopting AI now, we at Armilla help de-risk these solutions and help enterprises scale those AI applications to doing two things. One is providing a deep AI assessment, red teaming of these solutions. Think of us like a third-party independent auditor or a validator of these solutions. So as companies adopt them, they are very familiar with what the risks are. And the second thing we do is we actually have insurance products that transfer those residual risks that we are comfortable with away from these companies. So, as mentioned, Lloyd's will probably be the market that writes some of the first AI liability insurance products through us. Now, this trust problem is actually a big deal. While there's lots of hype around AI, these projects get typically caught in compliance risk. So there's a lot of POCs going on, but they don't go into production. And that's where the ability to understand and wrap your head around these risks is important. The insurance industry in and of itself, the regulators who are in the room, you are looking at providing guidelines on how insurers should treat these risks. But the same thing is happening in the medical space, in the financial services space, in banking, the EU AI Act, the regulations that are coming from the various federal government states is an indicator that we are worried about these risks. And that's why we do three things with these risks. Help identify them. So we go in and verify and validate these models to make sure that they're doing what they're supposed to. We then provide a guarantee as a risk transfer solution. So we can guarantee the performance of that model. And if it does fail, we provide a financial compensation back to the adopter of the solution. And finally, we will be launching our insurance products later this fall, which basically covers companies around the liabilities. Just as an example, we have an airline in Canada, which is where we're headquartered, by the way, in Toronto, that got sued because the AI model actually put out a wrong output, and the consumer was harmed. They would not honor it, went to the courts, and the courts sided with the consumer. Right? Now, that is a real liability that these companies are taking on. So they could have done two things. One, ensured that that system worked well by verifying and validating it. And once they're completely satisfied, then could have had some sort of liability coverage to protect them. Now, we follow a lot of the industry standards that are coming out. So the National Institute of Standards and Technology, the NIST, has a framework on how to assess these models, the ISO standard, and regulators such as yourselves who are putting out guidelines on how we should treat these models as we adopt them. All of this to say, we have a pretty comprehensive platform that does both a qualitative and a quantitative risk assessment of these systems through which we get the confidence to be able to ensure that the right AI is coming out. So we went to the Lloyd's lab a summer ago, or last summer, and as I said, here we are launching some of the first insurance products to cover the liabilities of AI written through Lloyd's.
Okay, thank you, Karthik. Now representing the company Sola, let's welcome Wesley Pergament to the stage.
Hi, everybody. My name is Wesley Pergament, and I'm the co-founder and CEO of Sola. We are a natural disaster MGA. So as we all know, home insurance premiums have been skyrocketing, as well as wind and hail deductibles have been skyrocketing. And a large driver of these increase in premiums is due to an increase in losses from these natural disaster events. And so that's due to a few factors, obviously climate being one of them, but another being the increase of population density of cities in the Midwest and Southeast, as well as aging roof conditions, of course, fraud, and sometimes even contractors knocking on doors and saying, I can replace your roof and get your insurance company to pay for it. And so as a result of that, what insurance companies are now doing to handle these increased losses is drastically increasing their premiums as well as increasing their deductibles. And so while that helps the insurance carriers ultimately improve their loss ratio and remain profitable, and of course contractors will always have jobs, it ultimately leaves the homeowner out on the side where they might have not been able to afford this new home insurance premium, or they have a $5,000 or $10,000 deductible, and as most average Americans don't have a few $1,000s in reserves, this can often be a trouble for them. And so what we've built is actually a supplemental natural disaster insurance policy that helps homeowners cover their deductible. And so the way that we're able to do this is our policies are specifically underwritten off of an objective third-party weather data source. So rather than needing to send out an adjuster to investigate the damage or investigate the loss and potentially have human variability components where one contractor says there are 10 hail hits on this roof, the adjuster says there's not. We have this, as I said, objective third-party data source that tells us where the damaged areas are. And so as a result of that, we then use that data to actually automate the claims experience and pay out homeowners within a few days. And so that ultimately enables us to provide coverage where most home insurance carriers are pulling away. As I mentioned, they're increasing their premiums and increasing their deductibles. And so because we just use that more simple, more objective weather data variable, we're able to come in and then provide this coverage where traditional home insurance carriers are not. And so this is known as parametric insurance, or just very simply using weather data to automatically trigger payouts. So we first launched our tornado insurance product about a year and a few months ago in 15 states across the Midwest and Southeast. We are now expanding our product offering to tornado, wind, and hail. As I just mentioned, all of the insurance agencies that we work with and homeowners said, hey, this tornado product is great. It covers an aspect of what we need, but ultimately wind and hail is that policy that helps them kind of complete that coverage. So when someone has a 1 or 2% wind and hail deductible, they can buy a limit from our policy of $5,000, $10,000, or for example, to then cover that deductible. We are happy to say we're fully reinsured through Lloyd's of London, so we participated in the Lloyd's Lab program. Let's see, it was probably about 2 winters ago. So it's been absolutely amazing. The Lloyd's market is extremely receptive to the innovative coverage forms that we're bringing, especially as the U.S. carriers have been pulling away from this style of risk. So Beasley was the first reinsurer for our tornado product, and then Tokyo Marine Kiln is now joining our reinsurance panel for our wind and hail program. So that is Sola in a nutshell. Thank you.
Thanks, Wesley. And our last panelist, representing CatX, Benedict Altier.
Hello, everyone. My name is Benedict Altier, and I'm the CEO and co-founder of CatX. And our mission is to bring new sources of capital into insurance. And the reason we think this is important is because as an industry, we're facing a series of critical challenges. And we've talked a bit about those challenges today, and I know I've talked directly with a lot of you about these challenges, which are the rising cost of insurance protection, the coverage gaps that we're seeing, and the fact that whenever there's a major catastrophic event, there's a supply shock, the prices rise as traditional reinsurance markets pull back. We think the problem is caused by the fact that risk is concentrated within the insurance and reinsurance world. And we believe that there's a solution lying in the form of alternative capital, which can help to bring stability and efficiency to insurance. So what alternative capital means is about bringing in new sources of capital from alternative investors. So these would be hedge funds, structured credit, pension funds, And they sit alongside traditional reinsurance players and help to share that burden of risk. And this is attractive to them because this is a market that's completely uncorrelated to the traditional things they invest in, like equities and bonds. And what that means is insurers can write more business, they can cover new risks faster, and improve capital management. But if it makes sense, then why hasn't this happened more often? It's a big question, we get it all the time, and the truth is, it is a growing area of insurance. There's now more than $100 billion of alternative capital, so non-traditional insurers holding insurance risk on their balance sheets. But to get that next 100 and the 100 after that, to solve these challenges, a couple of things need to happen. Firstly, we need to get brokers and cedents comfortable with the capital that's coming in so they can be confident it's going to be there when there's a loss. We need to work with regulators so they can understand the structures we're using and make sure that it meets all of their requirements from a solvency perspective and a KYC perspective. And most of all, we need to bring this capital in a way that they're comfortable holding these kinds of risks. And our solution for this has been to give them access to world-class risk modeling, but also to give them access to opportunities that are attractive to them, that means they can come in and support insurance companies. So what that means is we act as a new market. So where traditional reinsurers might pull back or increase prices, we can come in as a supplement or an alternative, particularly for US peak perils, Nat Cat specialty, but increasingly we're having conversations on hail in Texas and Colorado, and earthquake in California, wildfire, and even satellite insurance. There's a pretty broad spectrum of appetites. And the way we do this is to start first with the cedent, the protection buyer. Often this will be an insurance company or a corporate. And we're asking them to do something that's a little bit different. We're saying, we're going to a new source of capital for you, and we're going to ask you to transact in different ways and use different kinds of protection structures, like parametric structures that we've heard a bit from the last speaker about. So it's important, first of all, when we get to the platform, that we provide them with all the information they need to understand the options available, the pricing differences between traditional cover from indemnity-based protection from a traditional reinsurer, and what they can get from newer funds coming in. And once the cedent is happy, once the broker's happy, and also the regulators happy, at that point, we then share this information with our partner capital providers. So now we work with more than 40 funds, with more than 500 billion in total assets under management. And we show them this risk in a powerful deal room that explains insurance risk to them in terms that they can understand. We essentially have to be a Google Translate for insurance risk, giving them everything they need to get comfortable. We provide every model view available. We provide various modeling next to RMS modeling, next to CyberCube, next to RIASC, depending on the transaction. And this gets them comfortable with the risk and happy to hold it on their books. And when everyone is happy, cedent happy, broker happy, regulator happy, and capital provider happy, they're able to submit pricing, execute the transaction on the platform, and then post the collateral. We believe in full collateralization. So call me old-fashioned, but I think there's nothing like having money locked up that covers the entire risk for the entire period. And that's a really important part of our proposition. And providing details to regulators and insurers on that capital is key as well. Technology makes all this possible. We as a company are not a risk-bearing entity. On one side, we have some of the largest institutional investors in the world, qualified institutional buyers. On the other side, we're working with the largest brokers, all of the largest reinsurance brokers, large global reinsurers and regulators. And we have to connect all of these people together in one platform, sharing a ton of data from modeling to capital information to reporting. And that's really our job. And it's a job that we take very seriously because we think this is a service that's vitally needed to help provide that stability. And we want to be working not only with Lloyd's and the Lloyd's market, not only with the Bermuda markets as well, but with everyone else. This is a challenge that we need to work together to solve, and I think tackling these issues, bringing together new capital, new ideas, new experience, as well as data standardization, multi-model views, is going to make the industry stronger and help to provide stability for the future and confidence that we can cover the new and emerging risks that we hear about today, from cyber to AI and more. Thank you.
Thank you, Benedict. Okay, so I think now we'll move into our Q&A. Are you ready for the Inquisition? Let's start. Our first question is going to be for Armilla and Sixfold. Last year, the NAIC adopted a model bulletin on the use of AI in the insurance industry, and it has now been implemented in many states. Regulators' main focus has been ensuring that AI tools are not used in a way that results in impermissible bias or discrimination. How do you think about these concerns, and how have you ensured compliance with the regulatory guidance that exists?
So we actually agree and do think that probably the single biggest concern that the regulators are focused on is the one we should all be focused on. If you're using AI models to help or to make decisions, how can we be certain that they're not introducing bias into the process of issuing insurance or underwriting insurance? How can we ensure that they're fair? How can we ensure that the outcomes are the same irrespective of all the different inputs? We have a fortunate way that we approach this because our models actually restrict themselves to only looking at traditional underwriting factors. The bulletin, as well as many of the individual state regulations and legislation that's been coming out, expands into looking at all the different types of factors that a model is going to use. But what we've done is take an approach and we say, if we can prove that our AI only looked at those things that an underwriter is traditionally allowed to look at. So in life insurance, your medical history, the information you disclose on your application, maybe some third-party data like MIB and a few other things. If we can prove that, then essentially we can also go the step further and prove that the models are being fair and that they're not introducing bias. So in working with a number of the regulators, we figured out a way to actually show what we call kind of a traceability log, which is hard for a human to actually show, like, okay, these are all the things that I actually considered in my head. But our AI can explain, well, I only looked at these things, so therefore it's unlikely or really, really unlikely that we introduced bias into the approach. But would love your thoughts.
So I think that's the starting point. We take a more holistic approach. So obviously we test AI models, so bias is absolutely a critical component or one factor in how a model behaves. There's multiple different issues that one needs to think about as well, right? So let me give you an example. Performance is a big deal, right? The training data that's used to train this model is important. You get performance out of that. But really, where a model fails is when it sees data that has not been trained on, so out of distribution data. How do you know how well your model is going to behave when it sees things it has not seen before? Right? Those are tests that you need to run as well. So while bias is important, we take a holistic approach. There's about 10 different dimensions against which we test: performance, reliability, robustness, security of these models, right? PII information being revealed. And just give you an example of performance. Let's say there's a model that takes in, reads documents and read a $1 million number as $10,000. That changes the game, whether it's a claims or it's a underwriting model, right? That changes the game on what the outcome is. So while bias is important, we think we actually look at it quite holistically across all of these other dimensions where AIs can fail, and that also protects the consumer at the end of the day.
Okay, great. This is sort of kind of a follow-up question, so let's just stay with you, Alex and Karthik. Some states have called for quantitative testing to measure for bias in the use of AI tools. What are your thoughts about this kind of requirement?
Absolutely. So so oftentimes when we talk about bias with our clients, right, it usually comes up as a subjective issue. They're like, how do you actually quantify it? And there are 4 or 5 different metrics that one can use, right? So you have something like 4/5 rule, right? So you treat 80% of the time the underprivileged class is treated same as the privileged class, right? So that means your bias is not focused from that standpoint, and that's a quantitative metric that you can use. But we also see bias coming in different ways as well, which is there's quantitative, but there's also qualitative measures of that, especially when you get into LLMs or chat models. Again, toxicity of these models, the way these responses are produced, does it veer towards, and there was an interesting conversation we had this morning where, let's say, a bunch of brokers are using one single model, right? What if the model starts only recommending a single type of policy every single time, right? That's not a consumer. We usually think about bias as a factor from a human standpoint, but there's actually algorithmic standpoints as well. That is also bias, right? So I agree, but I think we need to increase the aperture of what we think of as bias.
I agree, Kartik, with a lot of what you said, so I'll only add one thing quickly. I think quantitative proofs are necessary. I really do, because I think it's a way that you can mathematically show that you're not introducing bias. And I think the regulators and the NAIC should take a more active stance in modeling some of that and leading with what could this look like. It's a heavy burden to be placed on an industry, but a fair one. And I think actually laying out a little bit of what looks good and what looks bad from a testing framework will help insurers and certainly help insurtechs get a little bit further along that curve of providing the data.
Excellent, excellent. Okay, let's move on over to SOLA and CatX. Many property insurance markets have struggled in recent years to have enough capacity to meet demand and to provide consumers with the coverage options they need. How are your companies addressing these challenges and fostering a more resilient property insurance marketplace?
So to start, what we've heard from a lot of the insurance carriers that we have conversations with is that their reinsurers are telling them to write less wind and hail risk, to expand their deductibles, and ultimately this leads to less coverage for the homeowners. And so what we have built is a completely new reinsurance stack from how the traditional home insurance carriers are built. And then what that enables us to do is build these supplemental products that can come in and provide coverage where traditional home insurers are not. So as I mentioned before, really that ability to have this objective third-party data trigger to actually trigger the claims process enables us to enter markets where traditional carriers are pulling away.
Yeah, absolutely. And I mean, from the sort of perspective of capacity providers, parametric is incredibly appealing, especially to new capital coming in, because firstly, they're concerned about this piece of how do I understand the risk? And it's much more simple to model whether this risk will occur versus whether this risk will occur and also the losses that it could cause. So it's a great structure for bringing new capital in, but also new capital coming in doesn't want to have to wait when they're leaving their capital locked up, have to wait for this sort of long period of claims. So having this binary outcome where there's certainty over how much they will have to pay out and when that payout will be triggered is incredibly helpful. And what we've seen in practice is rates have come down versus a similar indemnity product by a significant proportion, 40, 50% reduction in rate online because of the structure that's used. And obviously there's some challenges. There's things like basis risk, so that the chances an event happens and the coverage isn't triggered. So there's a lot to work out there. But I think the more that we explore modeling using what we know about historic losses and predicted future losses, the better we're going to be at assessing the basis risk and making sure this is a solution not only for the capacity provider, but also for the cedent and the protection buyer. Which is obviously the most important part of all of this.
Okay. This next one is directed just to SOLA. So Wesley, some regulators have expressed concerns about parametric insurance in terms of whether the products are actually structured as insurance, since they don't have a traditional indemnity trigger. How does SOLA think about this issue?
Yeah, it's a great question, and that is a core component of how we build our policies and our coverage. The way we design our policies is we work with a lot of different weather data providers, but ultimately what we're doing is building a model that has a high correlation with home insurance claims. So, for example, as Benedict was talking about basis risk, we've seen other parametric policies that might just be based off the hail diameter. But when we find out that we add in factors like the angle of attack of the hail, the duration of the hailstorm, we can get a lot closer to actually building a map that accurately predicts where the home insurance claims will be happening anyway. And so as a result of that, we think it's extremely important to build these triggers so that they have that high correlation with home insurance claims and how traditional homeowners understand how indemnity insurance works today. And then another important component is I would also say our policies aren't just full parametric. We also understand the value in verifying damage as well. So we have the weather data component, which tells us where to look. And then the second component is actually verifying that severe property damage has occurred. And therefore, when we pay people out, we can be extremely confident that they'll have that threshold. They'll be out of pocket that probably a little bit more than what our policy will be paying out. And so that's where we can come in, cover the deductible, while the home insurance carrier can then cover the rest of the claims.
Okay, thanks, Wesley. Next question is for Cat X. Benedict, how do you see the role of alternative capital evolving in the insurance industry, particularly in addressing the challenges posed by rising insurance costs for high-risk areas like Florida hurricane and California wildfire?
Yeah, I mean, absolutely. I mean, this is the sort of key reason that we believe that alternative capital is desperately needed, because a lot of the challenges come from the fact that these large reinsurers are already massively exposed to these kinds of risks, and that with any kind of systemic risk like hurricane or cyber attack, they're liable for significant losses, and obviously there's a lot of protections in place that regulators require to protect consumers and businesses and protection buyers that sort of mean that they can't carry too much of this risk on their books. So if the goal of insurance is about spreading risk among the maximum number of people to share that burden of risk, bringing new capital in that's not already exposed to this risk allows for more competitive pricing, but also stability as the risk is shared across a broader section of the economy. 100 billion of losses is a major significant event and disruptive event in the insurance industry, but $100 billion of losses across broader financial markets, I mean, we see that in intraday swings all the time. So it's about how can we broaden the number of people who are carrying this risk burden? How do we make them comfortable? And that for us is a clear solution to some of these challenges. It just requires a lot of collaboration between all sides, requires a lot of data quality. We're essentially a data science company to get these companies and funds comfortable with the risk. But it's solvable, and we've seen firsthand that we can be competitive and help to bring down rates.
Okay, we're going to go back to Sola for this one. It's a multi-part question, so I'll just do it in two pieces here. What do you see as the greatest challenges in expanding the availability of parametric products, and what can regulators do to help improve awareness and availability of these products and the coverage gap that they might feel?
Yeah, absolutely. So on the capacity side, and this is what's so great about Lloyd's, is their open approach to new styles of risk, new ways of paying out claims. And so I really, truly believe that Lloyd's was really like the only market that had the ability and capacity to underwrite like what we were looking to do as we were really building a new style of insurance policy forms and new claims experience completely from scratch. In regard to the regulator side, as I mentioned before, what makes insurance is being able to pay out people when they experience a loss. So validating that the data triggers for claims that have a high correlation with the actual loss is extremely important. And that's a strong tenet as we're building out our models and our claims procedures.
Okay, and then the second part of that is just what initiatives or incentives can be introduced at the regulatory level to encourage the development and adoption of parametric insurance products as viable risk transfer mechanisms?
Yeah, well, it all goes back to education. We spend a lot of time educating our insurance agents about how the product works, making it extremely clear before they're selling it to their homeowners about what this product actually does and how it performs. Obviously, the homeowners and the marketing material that we develop as it relates to how this coverage operates. But from the regulator piece, I think understanding, like people have a conventional notion of even how they understand parametric insurance. And so sometimes that might be government data sets that are completely free and accessible. And sometimes that means pulling in private data sets because they have that higher correlation with claims. And so I would just say from the regulator side, especially being open-minded as we're trying to build out new coverages, is that we want to incorporate all the data sets that we can, ultimately, so we can build the best coverage for the consumer.
Okay, another for CatX. What are the key barriers preventing broader adoption of alternative capital in insurance, and how can regulators and industry stakeholders collaborate to overcome these obstacles?
I mean, it's a theme that we hear a lot at these kind of events, but standardization is very critical. I mean, it's so important to be comfortable not only with the data, but also any information about capacity providers, structures, where the collateral is, what it's worth, what will be the sort of events that trigger it. So standardization of contracts, standardization of modeling information, all of this is going to be key to bring new entrants in, and we see significantly more interest when we can provide information in a clear, structured, standardized way. So that goes a long way. I think it's also getting comfortable with the structures that we use. I think full collateralization for us is key, but also building rules and regulations around if insurance paper is needed, how we work with fronting insurers to make sure that protection is there, that the protection buyer gets solvency relief. So I think there's a lot of collaboration that can be done there. I think for regulators, it's about engaging us in the sort of and others as well in the challenges that you're seeing in terms of where the capacity need is. So is it, there's one conversation I was having earlier, hail in Colorado, is that where the challenges are? Let's try and figure out a way to get some new capital comfortable with this risk and try to tackle some of the pricing challenges we've seen.
Thanks, Benedict. I'm sensitive to time, so I wanted to make sure we allowed a little bit for audience questions. Does anyone have any questions for our panel? Yes. Public adjuster.
So I'll try to jump in just a little bit, and I think Kartik maybe too. I think AI is able to address the question as well as can probably help insurers get closer to a better outcome for the customer, which is ultimately what we all want. We want the customer to be paid the amount that they're properly owed to be made whole, while also checking for maybe some of the external factors like pressure from other parties and pressure to perhaps have a claim that's not in line with what the actual injury or what the actual event was. The advantage of using an AI to evaluate some of the things is that it can take the human factor out and apply a very consistent set of claims guidelines based on what the actual underlying policy was. Of course, a human needs to be involved to oversee everything, but I actually think it can improve the situation.
I think the only thing I would add is there's consistency to this, right? So every human will have their own element. If an adjuster X feels some way and adjuster Y feels another way, you will have a lot of variability in how they're treated. So with a single model, you actually have consistency, and of course, everything Alex just said, I think that's the other element to actually using an AI system.
Okay, we have time maybe for one more question. Anyone from the audience? No one? Bueller? Okay, well, we're going to give you back 40 seconds of your day. Thank you for attending, and thank you to our panel.